Good morning everyone, my name is Naurin Shaji and today I am here to introduce you a new topic, that is AS11, the effects of changes in foreign exchange rate. So I'll be dealing with its meaning, its objectives, its scope, and the rest of the portions will be dealt by my teammates. So first we are going to look what foreign currency accounting involves. So, accounting for foreign currency transactions involves converting foreign currency activities into companies' reporting currency, selecting appropriate exchange rates and recognizing gains or losses from currency fluctuations. So, by telling in a simpler form, we can tell that the foreign currency accounting involves converting foreign currency, use correct exchange rates and record currency gains or losses. So next we are going to look what are the objectives of foreign exchange activities. So the objective of foreign exchange activities may engage in foreign currency transactions, which means transaction in currencies other than the reporting currency. And next is operations. That means foreign operations which include having branches, subsidiaries or ventures in foreign countries. So, to incorporate foreign currency transactions and foreign operations into financial statements, these need to be expressed in the enterprise's reporting currency. Key issues involves selecting the correct exchange rate and recognizing financial effects from the changes in exchange rates. So next point is convert to reporting currency, choose exchange rate, record exchange rate changes. This all comes under incorporation into financial statements. And by telling the objectives into a simpler form, the foreign exchange rate activities may engage in transactions, operations, that means foreign transactions and foreign operations. Then the incorporation into financial statements are convert to reporting currency, choose exchange rate, record the exchange rate changes. So next is the foreign currency accounting scope. So in simple, it is applied to foreign transactions and operations. The first one is foreign transactions, that is accounting for foreign currency transactions, and foreign operations, that is translating financial statements of foreign operations. And next one is it includes forward exchange contracts. So first one is foreign currency transaction with the forward exchange contracts. So next is the disclosure, that means non-domestic currency. So disclosure required when using currency other than the domestic currencies. So next we can discuss about the exclusions. That means it excludes convenience conversions, which means converting financial statements for user convenience. And next one is cash flow presentation. That means cash flow statement presentation for foreign currency transactions. And next is interest cost adjustments. So the exchange difference on foreign currency borrowings affecting interest cost.
Foreign currency transactions are issued at the Institute of Chartered Accountants. First one is discussed about the initial recognition of foreign currency transaction and reporting its subsequent balance sheet and recognition of exchange differences and net investment in a integral foreign operations. And first one is discussed about initial recognition of foreign currency transaction. Now we are discussing recognition of foreign currency transactions. First one is identify the transaction and determine the change rates and record the transaction and monitor of the change. So next one we will discuss about recognition of exchange differences. Means exchange differences arising from the settlement of revaluation of monetary items should be recognized and the income and expense in the end of the period. So now we have discussed about the last point is net investment in a non-integral foreign operations. First one is exchange difference related to the integral foreign operations, like example like foreign subsidiaries, and accumulated in a foreign currency transactions reserved and recognized upon the disposal. Like the example like for Indian company. So the example is the Indian company subsidiary and the net asset is increased and the differences recognized in the income statement, and finally the recorded the separate reserve unit in the subsidiary is sold.
Now we are moving with the terms and its meanings used in accounting standard 11. Let's do one by one. First one, average rate. Average rate is the mean of exchange rate in force during a period. Now second one, closing rate. Closing rate is the rate in exchange rate at balance sheet date. Third one, exchange difference. Exchange difference is the financial gain or loss resulting from changes in exchange rate when converting currencies. Now, exchange rate. Exchange rate is the ratio for exchange of two currencies. Moving to fifth one, fair value. Fair value is the estimated price at which an asset would sell in an open unbased market. Moving to foreign currency. Now, foreign currency is the currency other than the reporting currency. Often, sixth one, foreign currency. Foreign currency is the currency other than the reporting currency of an enterprise. Moving to second one, foreign operation. A foreign operation is a business activity conducted by a company in a country outside its home base. Eighth one, forward exchange. Forward exchange is the on-right means an agreement exchange difference currencies at forward rate. Now moving to ninth one, forward rate. Forward rate is the specified exchange rate for exchange of two currencies at a specified future date. Now, third one, integral foreign operation. Integral foreign operation is a foreign operation. The activities of which are integral part of those of the reporting enterprise. Now, 11th one, monetary items. Monetary items are the money held and the assets and the liabilities to be received or paid, fixed or determined amount of money. Now, last one, 12th one, net investment. The net investment is an non-integral foreign operation, is the reporting enterprise share in the net asset of the operation.
classified into integral operations and non-integral foreign operations. So, integral operations are the operations which acts like an extension of the company. For example, whether a company sells the product and in exchange we send back in the earnings. And here the non-integral foreign operations are the operations which is independent, handling its own cash flow, expenses, sales, mostly in the local currency. In integral operations, the exchange rate affects the main company's cash flow statement directly, whereas the non-integral foreign operation affects overall value of the company investment rather than the day-to-day operations. So now let's discuss about how integral foreign transactions are treated. So it is treated as if the transactions were part of the main company's own activities, and in case the assets like fixed assets and inventories are translated using the exchange rate at the time of their operations. And if the value of an asset needs adjustment, it is adjusted to the exchange rate at the time when the value is determined. Next is the characteristics of non-integral foreign transactions. So, non-integral foreign operations are independently with activities which is financed locally, and these transactions are not directly tied to the main company. The sales and expenses are mostly in local currency. So these are the characteristics of the non-integral foreign operations. Next one is the treatment of non-integral transactions. So these are the transactions which operate more independently from the main company. And in this case, we use different methods for translations. And in here, the assets and liabilities are translated using the exchange rate at the end of the reporting period. The income and expenses are translated at the exchange rate on the date of transaction occurred. And any difference that arise from this transaction are recorded separately under the foreign operations is sold or disposed of.
So good morning all. Today we are going to be talking about disclosure requirements as per AS11. Starting with exchange difference in profit and loss. As per AS11, the company should disclose the exchange difference in their profit and loss statement. Let's say suppose it with an example. Suppose a company operates in India but has a transaction in USD. During the year, it records a profit of INR 5 million. Due to the exchange rate inspection, it incurs a foreign exchange loss of 0.2 million. As per AS11, the difference should be shown in the profit and loss statement of the company, so that allowing the stakeholders to know the impact of the exchange rate on the company's earning. Second, we are going to talk about reporting currency difference from domicile currency. So again, let's explain it with an example. An Indian company might present its financial statement in USD rather than INR because a significant portion of its revenue comes from US market. In this case, AS11 requires the company to disclose the reason for choosing USD over INR, such as to align with the currency of its primary customer base. Okay, so second we are going to talk about transitional provisions. The first we are going to talk about reclassification of foreign branches. According to AS11, the company should apply specific accounting treatment as outlined in paragraph 33-34, adjusting the accumulated exchange difference in equity rather than recognizing them in the profit and losses. Second, we are going to talk about long-term foreign currency and monetary item, paragraph 46. Suppose an Indian company takes a USD loan in 2019 to purchase a machinery. Due to currency fluctuation, the Indian rupee equivalent to the loan changed by INR 1 million. Under the paragraph 46, the company has the option to adjust the exchange difference against the cost of the machine, depreciating it over the assets remaining life, rather than expensing it immediately. These provisions allow more gradual impact on profitability and matches the cost with the assets used. So we are going to talk about amortization of exchange difference, paragraph 46A. It's the same as the old one, but in this, the difference, the exchange difference, like in the last example, we took like around $1 million. Let's for example, the difference is around 0.2 million. That 0.2 million balance will be shown or would be amortized part by part in the profit and loss account until the loan's maturity. This spreads the effect of currency fluctuation, providing a stable impact on earning over the time.